Okay. Okay, I think we'll get started. So hello, everyone. Welcome to the second session in this series on the political economy of liquidity, which is hosted by Columbia University Center on Political Economy. I am one of the co-directors of the center, and I'm launching one of our idea labs, which is the idea lab on money and finance. And Matthias Thiemann, who teaches at Sciences Po in Paris, has kindly joined me in the effort of putting together a seminar series that is completely online, accessible to anybody who registers, in which we want to explore some core issues about the political economy of money and finance. And it was really Matthias' idea to say, let's just focus on the political economy of liquidity, because that's where really it all comes together, where we have to think very hard about the intersection of regulation and monetary policy, about the evolution of financial markets and their governance and their political economy, in our view, just written into the system. So I just want to welcome all of you. I would ask all of you to mute yourself if you're not speaking. I also want to make an announcement. You probably heard when you joined our session that the session will be recorded. Last time we said we would record only for archival reasons, to be able to write our notes. I now got quite a few requests on social media and on other sources to make that our sessions available exposed for people who cannot join us. We are considering this. We haven't set up our own webpage yet, so once we might be able to post them. So I asked already the commentators whether they would be agreeable to posting. They said yes. That leads me to suggest, if you do not want to be seen online here, close your video, or maybe also if you're sensitive, then close down your name as well. I just want to give you this option so that you know we might be posting. We haven't fully decided yet. So if you have problems with that, then take your own precaution if that's okay with you. But without further ado, I want to hand this over to Matthias, who's going to manage and guide today's session, and I will chime in later with questions of my own. I should also say to the audience, of course, we want to welcome your questions. We are hoping to have a lively discussion. We also hope that you found the readings. If you have had any problems accessing the readings, please just drop me a chat or send me an email so we can make sure that everybody can access what we have assigned. It's, of course, a soft assignment, but sort of proposed to read before these sessions. So, Matthias, the floor is yours. Thank you.
Yeah, thank you very much. And thank you very much for joining us today on the topic of financial innovation and liquidity management, the second of a series of 4 lectures and discussions this fall. Last time we had liquidity management in the private sector with Richard Carl Ramirez and Noémie Pinardon-Touati. And today we will, I think, pick up a little bit where we left last time with 2 excellent speakers. And we're really grateful for both of you, Richard Clarida and Sam Knafo, for joining us today. Sam Knafo, who's a lecturer as a reader in international relations at Sussex University and a great scholar of the history of liberal governance, most famous for his book, The Making of Modern Finance, on the Bank of England, will go first and give us a historical perspective on financial innovation and liquidity management. And then Richard Clarida, who is the C. Lowell Harris Professor of Economics and Professor of International Public Affairs at Columbia University and the former Vice Chair of the Federal Reserve, currently working at PIMCO, will then join us in another 15 minutes presentation, during which he will discuss also monetary policy in the current conjuncture, as well as shadow banking. So please believe me if I say I'm really excited about this event, and would like now to hand over to Sam. That's good for you, please. Thank you.
All right, thanks, Matthias. Basically, what I want to do is to make 3 broad comments that relate to the question of financial innovation and how we frame questions of financial innovations and the relationship to politics. The first one is maybe a way to kind of set in context the text that I circulated and the kind of work that I do by basically contrasting 2 different ways, I think, of thinking about questions of financial innovations. I guess the first one is probably by far the most popular in the field, especially in the field of political economy, where I come from. And this is really an approach, a perspective that frames questions of financial innovation more or less from the perspective of the state. And what I mean by this, it's really from the perspective of central bankers, financial regulators. It's related to the question of how financial innovations undermine or challenge in various ways the practices of governance that are set. And so here, from this perspective, we often think about financial innovations as undermining these practices, partly because they allow financial agents to avoid regulation. Sometimes it's simply that the new practices, the practice of governance, are no longer able to keep up with the new financial innovations. And so that's really the focus of this literature, is try to think about how financial innovations pose problems for practices of governance. Often this leads to some kind of discussion of the ways in which finance is being fragilized through time, through all these financial innovations, leading to a multiplication of crisis of liquidity, a broader financial crisis. And so that's a broad perspective on this question of financial innovation. I would say is vastly dominant in the literature on financial innovations. I guess the way I frame it's maybe taking a slightly different perspective on this question. I'm interested in thinking about financial innovations more from the perspective of banks. And so mostly try to think about the ways in which these innovations build new capacities that banks exploit to navigate the changing global economy, many times to try to take advantage of it, sometimes just to keep up with it. So I'm more interested in what is being built through these financial innovations in terms of capacities for these banks. So I guess if the first approach is more interested at how do we think about finance, especially around the problem of what happens when things go wrong. So when you have financial crisis, the focus is really on think about finance by focusing on the problem of crisis and how we prevent it, how we manage it. I'm more interested in what happens when finance is supposedly running smoothly and some of the issues that come from what is done with these kind of financial innovation, financial practices by banks in particular, but more generally other financial agents who are using these practices. So that's my first point, just to kind of frame a bit the perspective. I'm not saying that one is better than the other. I think both are quite complementary in many ways. But what I want to highlight is that I think each of these afford us a very different perspective on the questions of finance and financial innovation. They allow us to see very different things. And in that respect, I think they both have a lot of value. And I'm trying to kind of develop this approach, the second approach. That's my first point. The second one has to do with how do we think then about what is striking about these financial innovation in the age of financialization. And as for those who've read my text, you will have seen that. And one of the big claims that I put forward is that when we're trying to come to grips with the developments around financialization, of the ways in which finance has transformed in profound ways, for some from the 1980s, but I would argue along with others that really we're going back to the late 50s and early 60s, that from that point is a radical transformation of finance. And this is driven by a set of practices that are related to the practice of liability management. What's liability management? Really, basically, it is a transformation in the way that banks and other financial agents raise funds. Instead of chasing deposits from corporations or households, they started to systematically raise funds from money markets. And essentially what this means is that they're raising funds from other financial agents or treasuries that are basically doing the work to collect these funds and then lending them wholesale to banks, so in much larger volume. And this has really radically transformed the way banks raise funds, allowing them to leverage in radically new ways. There's much discussion about money market funding in the literature, but I think it's really important here to highlight that it's not simply about money market funding. That's not, because there's nothing particularly new about money market funding. It's existed for a very long period of time. A lot of people have talked about these practices in the 19th century, various practices of money market funding. And so you can go quite far back. It doesn't really capture what's different about financialization. For me, what's really important about liability management is a much more profound paradigmatic shift in the way in which banks raise funds on money markets. And this has to do with the fact that banks start to systematically look for funds in very different places, build up new channels, new instruments to raise funds. They start to compare very actively different ways of raising funds over different time periods of time. And so really what they're doing is starting to adopt a trading strategy, a trading approach to liabilities. And this, I think, is really the distinctive feature of liability management, something that gets really crystallized in the fact that some of the banks that are leading this transformation start to isolate the liability management desk, the desk that's responsible for raising funds on money markets, and turn it into a profit center in its own right. And so you really capture what the new way of thinking about liabilities and funding in this revolution, which really anchors, if you want, a trading approach to raising funds. I think what's really basically, folks, just to make it clear, really here now, the liability management desk is seen as a profit center, as I said, based on its ability to raise funds at a cheaper cost than what might be expected from indicators that you have on the market. And so it's really the performance of that desk and its ability in raising funds that is seen to be profitable or not. So that's in essence what's really revolutionary about this practice, and it's important because it develops new capacities for raising funds and leveraging that will completely transform the kinds of strategies that banks pursue. Here, so what I do in my work in various contexts, but the book that I'm writing is really to systematically track the ways in which these new practices of funding become a competitive advantage that is exploited in various ways at different junctures. And it is about the way it allows banks to grow, to expand their balance sheet, to leverage, allowing them, really giving them a new, to put in really crude terms, it's about increasing the purchasing power of banks. So a lot of banks being able to, making it easier for them to capture assets, capture up their banks, and expand their balance sheets in various ways. I've been not just looking at this as a quantitative growth, but really important in the work that I've done is to try to pick different sectors where you see this at play. So just to understand how these new funding possibilities start to have not just a quantitative impact in terms of raising leverage, raising risk-taking, raising increasing the balance sheet, but trying to focus more specifically on what kind of qualitative transformation this leads to. So I've done work with Sahil Dutta on basically trying to track how this played out in the field of corporate governance. So together we looked at how these new funding strategies led to a new financialized approach to management, how this basically buttressed the rise of conglomerates and later corporate raiders. And this is really the foundation for one of the most, if you want, unstoppable force, I think, in finance, the rise of leveraged buyout firms, investment funds that are colonizing various aspects of the economy by using the various tools, leveraging tools that they have, providing them with a competitive advantage that's very difficult to match. Now, currently I'm doing similar work on the rise of subprime lending, trying to track again how these new practices of funding were crucial to the way in which subprime lending emerged. I'm really struck by how little there is on the actual emergence of subprime lending as a practice. So I've done work with Pasquale De Girolamo and Mareike Beck. We're basically looking at that early history, and again, trying to factor in how this competitive advantage really helps us see some concrete transformations that are taking place in that field. And I think in that sense, it provides a new insights, if you want, in terms of thinking about how financial innovations are connected very directly to power dynamics in the field of mortgage finance. This leads me to the final point that I want to make, and this is about how we think about power, because this is a series that's set on trying to think about political economy. So how do we think about the politics of some of these developments. And here, maybe I'll raise what might be more controversial claims, or at least raise a few points about the question, how do we think about power in terms of these innovations? Because I do think that although the concept of liquidity has been very insightful for thinking about questions of crisis and many developments in the field of finance, I do think there are issues with the kind of purchase it gives us to think about, the purchase it gives us on the phenomena of power in the field of finance. Now, the two main points I'll raise here that I think are problematic, and that's a bit what I tried to articulate in the paper that I circulated. My first problem with the concept of liquidity is this is very much a concept that's been developed by economists, and it does a lot of good work for the kind of economic writing about finance. So there's lots there that is very rich, and it goes back to Minsky, and there are lots of people who I think have done tremendous work. But I do think there are limitations precisely because of this angle in terms of thinking about politics for someone who comes from the field of political economy. And the real issue here is that the concept of liquidity really tries to get at a quality of assets that emerges out of market interaction. So really about collective dynamics at an aggregate level, about how many actors interact with one another. And so it helps us capture certain things, but it's not very good for us to think a bit about how specific agents exert power over others. I'll give you an example here, and which really goes at the heart of what I'm arguing in the paper. So I'm really struck that one of the main concepts that has emerged in this literature on liquidity has been the idea of the hierarchy of money. Really this idea that when we think a bit about power in finance, who basically controls the main source of liquidity, the most liquid assets, are in some ways at a higher level in the hierarchy, have more power. And this certainly is valid, again, if you think about it from a governance perspective. But if you think about it from my perspective, from a financial perspective, I think it's quite limited in terms of really getting a purchase on what's new about financialization. Here, one of the things that I highlight is it's quite interesting that some of the agents that have played a really important role in transforming the global economy at various levels. And you're thinking about some of the key actors that are really distinctive about the era of financialization. Leverage buyout firms, hedge funds, but even lots of the banks that are really taking the leadership are really actors that have been leveraging quite dramatically. And so these are agents that have been trying to move down, if you want, in many ways in the hierarchy of money, and have been able to exert power precisely because of their ability to, borrow more liquid resources from others increasingly at a cheaper price. And so it's led to a different dynamic that I think, if we want to capture really what's new about power in the age of financialization, we need something more. We need to try to understand how dynamics of leveraging cannot be really understood. The power that they provide cannot be understood really on the basis of the concept of liquidity. We need something a bit that is different. And so, really what I'm confusing two different things. What I wanted to highlight here at the end is that the point I make in the article is that right now we're emphasizing a lot the problem of rentierism, the ways in which financiers are using their power to extort more and more punishing terms, or more and more troubling, difficult, imposing terms in terms of higher interest rates and all this on other agents. But in many ways, what's really striking about the power of key financial agents is their ability to leverage, to borrow more and more at cheaper prices in order to be able to push the resources that they have to do more than what they could be doing. And so in that sense, it's exactly the opposite, if you want, of how we tend to think about power and finance generally, where we think about it more as a rentier, an agent that's basically imposing terms for someone to borrow resources from them. In reality, what's really interesting about financialization and so shocking, I think, in terms of the dynamics it's led, it's exactly the opposite, dynamics of leverage. So I stop right there.
Thank you very much. That was a very good introduction to the power of hedge funds. I think agents we will get back to who can exert that power based on leveraging the capacity to get cheap funding for their investment strategies. But before we go there, I want to give the floor to Richard, and then open up the floor to discussions. As Katarina said, feel free to drop your questions in the chat. Of course, also whoever raises his hand then gets to speak. Of course, this is open mic, so to speak. So, but for now, it's Richard now. Richard, please. Thank you.
Thank you. And I learned a lot from Sam's overview. So I think my remarks will complement that. I'd like to provide some context on the very broad and important topic of the relationship and evolution of both what is sometimes called shadow banking and more recently a focus on non-bank financial intermediation, because they are related, but shadow banking and non-bank finance are related, but in many ways distinct concepts, although they share some common threads, and each is of concern and on the radar screen of policy makers. And here I think defining terms is important. And so the term shadow banking emerged in the 1990s, early 2000s, as a way to describe what was really a parallel banking, unregulated banking system that emerged primarily in the US, but in other jurisdictions. And the distinguishing feature of it is that shadow bank institutions undertook many of the same functions that banks did. They raised funds in markets with the promise of safe investments, very liquid, and then they engaged in maturity and credit transformation. So if you ever took a money and banking course in college, that's one of the things you learn, that traditional banking does both maturity and credit transformation. Now, traditional banks raise a lot of their funding, not all, but a lot of their funding through deposits, which in most countries are insured. And that's obviously valuable to banks because that insurance and their ability to borrow from central banks like the Fed gives them an edge. And so as a trade-off, they are more tightly regulated. So shadow banks emerged and became a big part of this financial system, and in the US, a big part of the problem that was revealed by the global financial crisis. And because many of these shadow financial institutions did have credit exposure, when credit spreads widened and the financial system was perceived as being more risky, there was a big hole between what the value of their assets were worth and the amount that they were funding here. So various versions of these would be so-called asset-backed commercial paper, where you had vehicles that were set up that were funding essentially in commercial paper markets and then buying assets that had credit risk. You had the funding of some non-bank dealers, bond dealers, also were in essence shadow banks. And then the money market funds themselves came under stresses. And so as a consequence, the Fed during the 2008 global financial crisis stepped in and essentially backstopped the US shadow banking system. It set up programs to support money market funds, to support the commercial paper market, to support credit code and auto loan receivables that had been securitized. And then many financial institutions, some prominent financial institutions that were not established as banks, became banks. So the two most prominent examples being both Goldman Sachs and Morgan Stanley are now set up in what's called a bank holding company structure, which puts them under the Fed's umbrella. Fast forward to today, there's much less discussion in policy circles on shadow banking, but much more of a discussion on what goes under the rubric of non-bank financial intermediation. And one of the pieces that I suggested that you read or have access to is a nice chapter in a recent IMF report. And if this piece is useful for nothing else, it's useful for actually defining how do policymakers define non-bank financial institutions. And so just looking at this table in the IMF report, I mean, this category would include, for example, asset management companies and investment funds. Think mutual funds that invest not only in equities, but also invest in investment grade bonds, mortgage-backed securities. Insurance companies are included in this category. Pension funds are included in this category. So-called structured financial vehicles, which are essentially vehicles that are probably most similar to the shadow banks that we were just talking about. Essentially, these are vehicles that raise money from investors and then invest the funds not only directly in the companies, but in what are called securitization structures, in which different riskiness of different pieces is sold to different investors. Hedge funds are, of course, included, and then central counterparties. And so this is a much bigger grouping of firms, and it's not only larger, but it's fundamentally different in many ways from the shadow banking challenges that I talked about earlier, in the sense that a lot of the firms that are considered to be non-bank financial intermediaries are actually not raising funds necessarily overnight or with any promise on redemption. A lot of times they're raising funds with people knowing that they can take mark-to-market or credit losses. And so there are different perceived levels of liquidity, and certainly different perceived levels of loss that investors can earn. For example, anyone who invests in a hedge fund may be able to get his or her money out quarterly, but there's certainly no reason to believe you're not subject to downside as well as upside opportunity. Similarly for many pension funds as well. And so the reason why the international policy community is now focusing intently on these so-called non-bank financial institutions, there are really several reasons. One, obviously, they're an enormous part of the system. Secondly, as we saw both in 2008 and then in the pandemic, if there's a sufficiently large enough shock to the system, these funds and these investment vehicles can compose a systemic risk to the financial system, and thus that risk encourages central banks to step in. In the Fed's case, for example, after the global pandemic collapse, the Fed set up facilities to directly, backstop the corporate bond market, for example, and also the municipal bond market. Those programs, the Fed never wanted to be the lender of first resort. It wanted to be the lender of last resort. In the end, the Fed did no lending in the corporate program and only did limited lending in the municipal program. From the Fed's point of view, with which I'm the most familiar, the Fed can only venture into providing liquidity, let alone lending or backstopping non-bank financial institutions under very, very specific and delineated provisions. Technically, this is something called Section 13.3 of the Federal Reserve Act, and Section 13.3 says that the Fed can lend against collateral to non-bank financial institutions, but only in, quote, unusual and exigent circumstances. And certainly in my time at the Fed and in my conversations with Bernanke and Yellen, Greenspan, the Fed has always, as an institution, taken this very seriously. It does not routinely want to venture into lending against collateral to non-bank financial institutions. In addition, the Dodd-Frank Act, which passed after the global financial crisis, tightened the requirements on the Fed for lending to non-bank financial institutions. And in particular, it limited the ability of the Fed, for example, to do what it did in the case of AIG, which was essentially to set up a special arrangement to keep the AIG insurance company afloat that it did not make available to other insurance companies, for example. So under Dodd-Frank, for the Fed to invoke 13.3, it needs to set up a program that is not only motivated because of unusual and exigent circumstances to the financial system, but also that is widely available. And again, Fed lending can only be against, in the Fed's judgment, against collateral. That's also important because certainly during my time at the Fed in the pandemic collapse, when we set up these 13.3 programs, we recognized that depending on the duration and severity of the pandemic, and in particular, it was not clear at all in 2020 that there would ever be vaccines. We had to be prepared that there actually could be losses on the loans, and so so the vehicles that were set up to provide lending to corporations and municipal issuers actually had a first loss piece that was provided from appropriated funds in the CARES Act, which passed Congress in March of 2020. And the Fed really needed that. Absent that, it would have been difficult for the Fed, under its interpretation of 13.3, to freely lend to non-bank financial institutions. So let me then conclude with try to provide some context for thinking about what is ahead. There are a couple points about central banks providing liquidity to non-bank financial institutions under duress. The first is almost all of these non-bank financial institutions on page 61 of this IMF report have relationships with commercial banks. And so when one thinks about the need for liquidity, one should think about, if these are going concerns, they have existing relationships with existing banks. And so the fact that a firm needs liquidity does not mean the only provider of that can be the central bank. The second point I would raise on regulation and gaps or holes in the regulatory framework, those are all well and good points. But again, virtually all of the institutions that would fall under the rubric of non-bank financial intermediaries are regulated. So, for example, AIG was regulated in 2008. That didn't prevent it from setting up AIG financial products and writing credit default swaps. So it wasn't a lack of regulation of AIG. It's just in those days, regulators chose not to regulate that activity. Another example are the challenges that were faced by some UK pension funds in October of 2022. I'm not an expert on the UK financial system, but I do believe those funds are regulated. And then again, a fund that is investing with long maturities to offset long duration liabilities, that's not necessarily a risky activity unless leverage is introduced. If I've got $1 million in liabilities and $1 million in assets, then that could be a hedged relationship. Is if I'm trying to juice returns by leveraging up those investments, then that's when risk is introduced. So again, I guess now reflecting my own biases and my own analytic approach, I do think it's important as you think about these issues to distinguish between the needs for liquidity, the sources of liquidity, and to the extent there are gaps in regulation, perhaps the best approach is to fill the gaps in regulation and not necessarily to think about ways in which central banks can become more intimately involved in backstopping these activities. So why don't I pause or stop there, and I look forward to your comments or questions. Thank you.
Wonderful. Thank you very much. We already have at least one, if not two questions or commenters. Maybe we invite those two first. So I see that Christianos Pramudito Isunanda has pasted something, or maybe I could take a moment to react first, Richard, to what you just said, which I thought was excellent. But my only question was, maybe these entities were regulated, but were they regulated from a macro perspective? I think they were regulated from a micro perspective.
Yeah.
The big issue that you referenced in 2020, what actually happened was that the hedge funds were caught on the wrong foot, and as their trades were unraveling, the whole treasury market was starting to get very, very wobbly. And I think many people got very scared. So I really hope we can discuss also the current attempts to regulate the leveraging of hedge funds and through repo markets, through treasury repo markets, and possibly the minimum haircuts that are currently discussed. But we'll get back to that. I think for now, I wanted to give the floor to Christianos Paramudito, please. If he's still there.
Yes. Thank you, Mr. Matthias, Prof. Pistor. I posted the question on the meeting chat. Actually, I read Sam's really enlightening paper, and I'm wondering. You mentioned before about the differences between the state perspective and the financial institutions perspective in financial innovations. I'm wondering if would you think that to some extent from the state perspective that they have a legitimate interest to support financial innovation, for example, to support the further market deepening, and if so, do you have any idea how they could balance the interest between the fragilization risk for a proper measure to induce the more market development? I think that's the point of my question. Thank you for the opportunity.
Yes, Sam, if you want to react to that.
Yeah, I guess it depends what legitimate means, but for sure, from the state's perspective, there have been conflicting interests, I think, and it plays out historically. So on the one hand, a lot of these developments have initially been convenient for state regulators, especially in the early history of the rise of liability management. I think people at the time didn't really realize some of the implications. And so you see some of the innovations that are developed to help commercial banks raise funding. These seem quite convenient because, for example, certificates of deposits and things like this, it allowed banks to continue to address a funding gap in ways that seem to suit everyone. But as these practices develop and regulators start to see the implication, then it raises all kinds of problems. And you could see, while the period I've been looking at in the 60s and 70s is very striking, how at the Fed they're constantly wavering in terms of how to deal with these developments. On the one hand, they're happy with some of them, but as they start to pose problems, they're trying to crack down and to put pressure on banks not to continue to leverage in those ways. And so it's really tricky. It's a big political question in that respect. So I'm not, I think in terms of, if we broaden it from the state's perspective, of course they support financial innovation but it all depends, what comes with it. And so it's not an easy question to answer in absolute terms. I think it really needs to be framed in relation to specific innovations. And here, I really feel there's a good book. You know, hopefully Sahil will put it out there. He's writing I'm sure will be a fantastic book on basically the ways in which the kind of change in the paradigm of banking that comes with liability management has forced a radical rethink of the nature of governance. And there's lots of great work there. Matthias, of course, has written some fantastic stuff on there. Leon van Slebens published a book recently. So there's lots of, I think it's a really important question in some ways to really come to term to think a bit about, you know, the ways in which liability management has really led to a paradigmatic change in the way governance is conceived, and it's a challenge we're still trying to deal with. It's far from over, obviously.
Okay, Katharina, thank you, Katharina.
Yeah. So thank you first, both of you, for these fascinating presentations. I think I want to pitch you maybe against each other a little bit more than you were willing to do yourselves, because I think Rich was saying it's pretty complementary to what Sam has said, but I read you in advance as being a bit more in different fields, and different analytical fields, to say. So I'm just wondering for Sam, if you push your argument and saying this is really not so much about funding, but it's basically you're levering up. The banks are levering up. They're finding new sources basically for in investing, and they're finding them in money markets. So we have to think of the liquidity management side much more than on the credit giving side. That should have implications both for financial regulators, but also for banks, central banks, right? Because if you think about always the credit channels, then you might be missing the liquidity management channels. And I think one of the puzzles we just want to pose for this particular session is how, you know, central banks and regulators that are supposed to govern these financial markets are actually perceiving what is happening and how they're responding to that. So I think in Sam's account, the story was different than is very often assumed to be. And therefore, we shouldn't be surprised that many of the mechanisms that were used didn't really work. Because essentially, we are still in the same world, right? We are levering up. We were levering up everything that we possibly can. And the central banks and regulators don't seem to be pulling at the right levers. I was reminded of the fact that I play harpsichord and I have to tune my own instrument. And if you don't listen carefully at which string you're tuning and you tune up and up and up, it cracks, right? So, and you know, in a way, you know, Rich, you also had in your paper a comment about sort of like inflation expectations. In 2012, everybody still was worried about not enough inflation, right? It was deflationary rather than inflationary. But at some point, this changed tune. I was actually wondering whether the central banks have cracked a string here. It's questions for both, but I just wanted to see whether you can come in a conversation with one another, saying, you know, there are different perspectives on what this financial innovation was about, what risks it posed, and how the regulators and the monetary authorities responded to it.
Maybe I'll jump in here. A couple things on liquidity. One of the significant changes post GFC is that big systemically important banks have to hold a great deal of liquidity, much more than they did before the GFC. So to give you a concrete example, big US banks in 2006 held somewhere around, say, 7 or 8% of their assets were in what we now call liquid assets, or technically the term is high quality liquid assets. And today, a big bank has about 25%. So banks have much more liquidity. The big banks have much more liquidity than they did pre-GFC. They also are subject to what can be a binding leverage ratio. It's called a supplementary leverage ratio. And so one of the implications is that big banks have on the asset side of their balance sheets more liquidity, and thus as a percentage of assets, less loans and other assets. And secondly, are limited in their ability to expand their balance sheets. And so as a consequence, some intermediation is moving out of banking into non-bank finance, and that was an entirely predictable consequence of all of these measures. In terms of Katerina, to your point about, I'm also a musician. I'm a guitarist, not a harpsichordist, but the same thing happens on a guitar. You can break a guitar string too, and I've done that many times. Especially an old guitar string. The new ones tend not to crack. I think that whether I think we saw with SVB in the spring that they're clearly, and I talked about all liquidity and lack of leverage in the mega banks, and that's true. But certainly the SVB episode did reveal that in the U.S. that we have a group of banks. They're not too big to fail, but they were too big to resolve over a weekend, and we had 3 that went under, and that did trigger a Fed response. The Fed set up a facility to loan to existing banks, and the Fed is also lending money to the FDIC in that resolution. So far that has not proven to be systemic, but that required an intervention by the Fed. On the inflation end, inflation is coming down. I think we won't know what historians will say about this episode until we see, where inflation ends up. But the inflation overshoot was really a global phenomenon, which I guess is not entirely surprising given the nature of the pandemic shock was global, as was the policy response.
Mm-hmm. I would have a follow-up question, Sam, or do you want to? I will go shortly, and then because my follow-up question, I think both of you can relate to that in a sense is, and I think it's interesting to think both the perspective of the private agent and the state together. It's the stability of liquidity infrastructures. And so here I would take the treasury market as the prime example, and the policies to deepen treasury markets and the liquidity of treasury bills and bonds. And I know Charlotte is here, so she's working on that. And so this is a state project. It's the attempt also to lower the costs of, it's on the one hand the attempt to lower the costs of refinancing for the state, and on the other hand, it's a great way to have a liquid market where agents really can use for liability management. And now I think what has happened in the last 3 years after COVID is that American and particular American regulators, the Fed, the Financial Stability Oversight Council, even the SEC, have realized the risks of what they call the hidden leverage of hedge funds when these deals that the strategies are coming unwound, where really suddenly you have a lot of selling of treasuries by these highly leveraged actors that transforms what was the stable backbone of the US financial system into something that becomes, at least in the short term, unpredictable. And I think that's where financial innovation and leveraging by hedge funds really have come to become almost orthogonal to the interest of the US state. And that's why we see all these attempts to get more data on them and to regulate them. And now the people are acknowledging that they really can't regulate hedge funds. So maybe we can also talk about why that is, or they really have a hard time. So what they do is they try to regulate the exposure of of banks, of the broker dealers, to these hedge funds. And then there the question is, and Richard, I heard you and I found this interesting, is you said that some intermediation has been moving out of banks into non-banks. But at the same time, we find that these are, I mean, I don't want to say that banks have been always bad weather providers of liquidity, but these non-banks are not bad weather providers of liquidity. That is to say, when the going gets rough, they disappear and the market can suddenly fall dry. And so the question becomes, I think the state agency becomes one of building stable liquidity. And that's when it becomes interesting, when it interacts with financial innovations. And so maybe you can both maybe react to that.
Sam, why don't you kick off? But
Yeah.
I have some thoughts too.
I just to come back, like, and maybe connect this. I'm not sure I'll answer directly what Matthias is raising, but maybe more responding to what Katarina was asking. For me, there's two different questions. There's the first one of thinking about how liability management is posing challenge for governance, and this has a lot to do with the fact that systematically we've underestimated what were the implication of these revolutionary changes. And I think this goes on and on and on in ways that every 10 years we look back and it's quite shocking to see the changes in finance. And so we're still caught up in this dynamic. And so that's the first aspect. And I think here, I don't think we're that far with Richard and me in some respect. Maybe different ways of framing, but we're pretty much, I think, looking at it from similar perspective. I guess what I'm trying to highlight is that it's not just about the crisis. The question of regulation and governance, we keep focusing all the time on making sure that finances remain stable. But this is in some ways it's not a limited, it's a very important one, but it is still a limited framing of the question of governance. And while we do this, while most of the focus goes there, we're not asking questions about what is happening with finance outside of that. So I'm quite surprised often at how little we make of all the predatory developments in finance that we've seen, and particularly since the 1980s. But you see this with, even by the 70s with the junk bond markets and all this, you see that systematically the new financialized strategies, the abilities to leverage, it has incited a dramatic expansion of predatory strategies, people who are innovating, developing new strategies really based on predatory practices. And this is nowhere to be, is rarely tackled in these questions. And these, I think, are really important issues of governance also. Right now, for me, one of the big concerns, and in the UK, it's a big issue, but it is everywhere, the whole issue of investment funds and basically leverage buyouts. How, when you see the way in which the infrastructures are basically taken up, public infrastructures are systematically taken up by these funds. You see it in the public sector at various levels. So much now of the corporate governance, the corporate market firms controlled by these firms. There are a whole series of issues there that I think also need to be highlighted more systematically when we raise questions of governance. It's not just about making sure that finance works smoothly and that we're there to make sure that it doesn't collapse. There are other big political issues that needs to be put forward, I think. And that's a bit what I'm doing, in all this work.
Matthias, on your point on the Treasury market, it's a good one, obviously very topical now. A couple of points. I wouldn't pretend to be an expert on it, but I do follow the work of Darrell Duffy at Stanford and others who have really focused a lot on this. And the way I think about it is we have, through historical evolution, economic evolution, we have a system in the US market infrastructure for trading treasuries. And I think Darrell's argument that I agree with is that it's really not kept pace with both the globalization of the treasury market as well as just the absolute size of the treasury market. And at the same time, the traditional intermediaries in the treasury market, the primary dealers, are now more tightly regulated and supervised, in particular their balance sheets. So there is a shadow price to cost to the balance sheet now that really didn't exist. So if a bank in 2004 saw a profitable opportunity in the treasury market, it could go after it, even though it would mean increasing the size of its balance sheet. They can't do that now. So as a consequence of many more treasuries that are being issued, the government debt to GDP ratio is 110%. 20 years ago, it was 40%. And in addition to the net issuance each year for budget deficits, you've got the gross issuance as securities mature. So the amount of intermediation that needs to be done has just grown exponentially at the same time that the traditional intermediaries are facing more constraints. So I do think efforts are underway at the FSOC to rethink and improve the Treasury market functioning, and I think that direction of travel makes a lot of makes a lot of sense.
Mm-hmm. 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 Yes, I think, I mean, thank you for both of your interventions. They're very, very helpful and clarifying. I agree that we should not only think about financial stability, Sam. I think that's very important. It's at the same time we can ask, what is the kind of trades that these hedge funds are doing, and it seems, as Stefano Sgambati has pointed out, these are low risk, high leverage trades, very small basis points, but they leverage up, and then basically they take advantage of some differences between future prices and then current prices in the treasury market. But then the question becomes, for me, the question becomes, in essence, one of the interventions of the Fed in 2020 in March, where, from what I have understood, it's literally a huge risk to the financial stability, which is caused by the unwinding of these deals. And so the Fed has to intervene to stabilize the hedge funds and the broker dealers who have lent to them. So in other words, power to me, and maybe that's the question where power comes again in, power to me is in that moment, the Fed doesn't have a choice. To me, in 2020, the Fed has the choice of either letting the system go down or intervening massively in order to allow a regular unleveraging of these hedge funds without that the whole system goes down. Because if these hedge funds go down, the broker dealers that lend them money are going to go down, and if the broker dealers that lend them money go down, then the whole system goes down. So it's this moment for me. It's chantage. It's I don't know in French, in English, it's a hostage taking. So
I like to call this. I like to call this blue mailing. We have green mailing in takeover scenarios, and we have black mailing. This is blue mailing.
Yeah, please. There are other hands up. I can see Jana and William, please. Sorry.
I think was first. Yeah, Viral was first.
Go ahead.
Viral, yes, please, Viral. Thank you.
Thank you, Sam and Rich. Really enjoyed the interventions. I was trying to connect your pieces a little bit, and I wonder if it has something to do with the pricing of the tail risks which are associated with leverage, because I think I fully agree that whether we like it or not, at least the only credible thing when the system is going to implode is to actually backstop parts of it. And you could end up with a big error one way or the other. But sort of one reason why it may be then morphing into the kinds of governance issues that Sam is concerned about is because maybe the cost of debt over time is becoming cheap as a result of these repeated interventions and backstopping. We know earlier, before the global financial crisis, that the cost of borrowing of too big to fail banks was lower, all else equal, than that of other banks. And increasingly now in markets, we are hearing that, risks of BBB rated firms getting downgraded to junk, or the risk of junk firms are not actually, the risk premia are becoming very compressed. And so essentially what I'm trying to say, long story short, is whether there's a connection between central bank interventions and not having ex-ante measures in place to then deal with its consequences, which in this case, in Sam's examples, would be things like LBO leverage, investment funds, redemption rights, etc. And then because the risk is not priced properly, it becomes very large. It becomes sort of too big to manage. And so I think the concern I have is whether if Fed wants to intervene in non-bank markets or non-bank parts of the system, whether we have no choice but to actually regulate them in good times, exactly the way we worry about leverage and liquidity of banks. And I think otherwise the two seem a bit incompatible, and then we'll just be shifting problems over from one place to the other.
Yeah, so just a quick comment on that. This has been a theme that I have emphasized for 15 years now, and it was a big contrast between the continental European and U.S. Approach. There was a lot of discussion. We haven't even talked about it too much today, maybe once, about the need for so-called macroprudential regulation. And of course, it's sort of like mom and apple pie. Everyone's in favor of it. But if you actually look at a lot of the work on macroprudential regulation, especially the work coming out of Europe, it was, if you look underneath the hood, a lot of it was really about how to better regulate big global banks, because in many of those countries, most credit's intermediated through banks. So a lot of macroprudential proposals were about down payments on housing and real estate exposure and the like. And that's all well and good, but in the US system, even 20 years ago, more than half of credit was intermediated outside of banks, and the share's just gone up even more. And there is really a much less clear-cut and much sparser macroprudential toolkit once intermediation moves outside of the banking system. So I think this is a work in progress. You know, the FSOC was set up to oversee those efforts, and we may begin to see more of it. But you know, right now in our system in the U.S., you know, regulation of markets and institutions is dispersed across a number of different organizations, and the FSOC is supposed to coordinate those efforts.
Maybe just to get back to this question, to Viral's question, great question. I find it interesting that in many ways it was always almost the opposite initially, because when you start to see the rise of liability management and you see you know, what liability management was in many ways was a means for banks to offer higher rates in order to capture funds. And so a lot of what it starts to do is really fuel competition for access to these funds, which saw, you know, various agents move towards increasingly high rates. And so junk bonds are part of the process in some ways, where you start to raise funds by offering increasingly high rates. And so it leads to the almost opposite dynamic, where because it costs you so much to raise funds, more and more financial agents are incentivized to move towards basically more predatory practices, or and into more risky types of finance, where you can get better returns to match the high cost that you get on the money markets. So you start to see a bit of a different dynamic. You're right, though, that as you have this big push, what's really interesting is that it does, you know, I think a big story of this, and this comes back to Katerina's question, what's really interesting is how regulators, the Fed, is basically increasingly tied into a role of accommodating all of these processes. Everyone's kind of pushing the leveraging, basically, as Matthias says, putting Federal Reserve and central bankers in an impossible position to act more and more as in accommodating ways. And so then you have this second phase that you're pointing out, and this is so there's an evolution that's quite interesting, and it leads us to the exact opposite perspective, where risk is underpriced in some ways, and then you get new possibilities. But I don't think it works only in one way. It had kind of fluctuated. There's a big shift right up until the 80s. You see the opposite is really pushing rates up, and with all kinds of implication of what's viable in that context. You know, banks increasingly saying we're not interested in doing safe loans. We need to move more and more towards risky debt, because it's the only way that you can match how much it costs to raise funds. And so you need to kind of have risky debt that that brings high yields to match this. And later on, after from the 90s onwards, then you get the kind of dynamic associated with what you're pointing out. And so I think there's really a history of historicizing this kind of development is really important.
Maybe we could have Jana. Thank you, Viral. And this was I think it was a very important point, possibly even that we're just creating too much debt, which compresses the price of debt ever further, and thereby like leads to these dynamics. Maybe we have Jana and we have William, and I would like to let the two of them in and then go on. Jana?
Yes, thank you so much for these excellent presentations. My question is for Richard, but Samuel can obviously jump in. So thank you for clearly kind of delineating and explaining the difference between shadow banks and non-bank financial institutions. We also know that Linda Goldberg, for example, she has recently warned us about heterogeneity, substantial heterogeneity, among non-bank financial institutions and across borrowing locations. And she more explicitly, she mentioned that non-bank financial institutions locate more in cross-border financial centers with less stringent locations, right? And we see a lot of these activities in emerging market countries. And so my question is, if we put more regulatory constraints on non-bank financial institutions or their activities, where would the risk then migrate, right? How we deal with this kind of global risk. And then second, maybe kind of follow-up question concerning the risk and liquidity. We know that, we have all observed, and some of you experienced also as part of your work assignment, this ongoing shift in global monetary policies. Notably increase interest rates, et cetera, et cetera. So how does decisions of central banks impact liability management for financial institutions, both, well, I'm mostly concerned about non-bank financial institutions. If you see the impact of contemporary monetary policies on liability management of these non-bank financial institutions. Thank you.
Ambitious questions. I will give what may not be an entirely satisfying answer just because they're very big topics. I think on your first point, I think it's interesting if you were to more tightly regulate and supervise non-bank financial institutions, then some of the flow of activity from big banks to non-banks would probably flow back to big banks. But only a limited amount, because the leverage ratios really are binding constraint for the mega banks. And then some activity just would not get done at all. And of course, the interesting thing that I think academics and policymakers perhaps don't talk about as much as they should is that, in a leverage transaction in the financial market, you can use that leverage either to help intermediate credit to a new activity, or to just refinance or refinance, an existing asset, right? And both can happen. And so, one scenario is you just make it more expensive for non-bank financial institutions. That doesn't really impact credit intermediation. It just impacts the ability to reprice or refinance existing assets. But of course, but it would impact. So I think there's an issue both in data and conceptually about how changing regulatory standards influences the mix between refinancing existing activity and credit intermediation. On the first point about monetary policy, I think it's not a subtle point, but it's an important one. We've gone through a period really from 2008 until maybe 2023 of 15 years in which riskless short-term interest rates were incredibly low, even negative in the Eurozone. And the Fed and other central banks did that because inflation was too low and the recovery from the GFC was disappointing. But one consequence of a low rate environment is that it does, incent strategies that, borrow short and lend long. If borrowing short costs zero for 15 years, you're going to get a lot of that. And we are seeing now, as central banks normalize, that the cost of those activities and those strategies is going up, and the system is having to deal with that. I think so far interestingly, without disruption in the non-bank financial segment, what we saw was a disruption in certain U.S. commercial banks, and then similarly in the UK with the gilt crisis. So I think we need to be prepared for a reshuffling in non-bank finance. If we are, as I think, going to be in a world in which riskless rates are going to be a lot higher than they were beforehand.
Mm-hmm. Thank you. Sam or William? I mean, if we can have William first, and then yeah, William.
Yeah, great, thank you. So I guess I'm curious about the moral hazard problem underlying these non-bank entities, right? So after 2008, we built this resolution regime for dealing with banks. But even though the kind of original G20 plan was to encompass all financial institutions, we really don't have much progress outside of banks. We don't really have anything for these non-bank institutions. But obviously there is moral hazard, right? As we've mentioned, like there have been interventions in these markets by governments. So I guess I'm curious to what extent that moral hazard is driving this growth of sort of liability management and of liquidity outside of the banking system, and what we do about it, right? So what sort of policies can be put in place to try to mitigate that moral hazard? Can we kind of port the bank resolution regime we've developed outside of the banking system? Are there other strategies? Yeah.
Couple points. Good question, William. On bank resolution, there was a whole architecture and superstructure developed for resolving systemically important banks. It was subject to its first test back in April with Credit Suisse, and the Swiss authorities decided not to deploy it. So that's only one data point, but that's the only data point we have about whether or not, even for big global banks, the resolution approach is actually fit for purpose, because the Swiss chose not to test it in that circumstance. As I said, again, now not surprisingly, perhaps, putting on from the Fed's perspective, the Fed does not routinely or without a justifiable serious disruption venture into supporting non-bank finance. Now, indirectly, you can argue when the Fed did what it did in September 2019, which is to backstop the Treasury repo market, that indirectly, even though that it wasn't supporting directly non-financial institutions, but it was financing a business model that relied on repo finance. So I appreciate that. I do think that the big mega banks are perceived as being too big to fail correctly, and the quid pro quo there is that they are tightly regulated and supervised and have lots of liquidity, and because of that perception, they have no trouble raising deposits as well. I do take the point, however, that whenever ex post you have interventions, there is a moral hazard risk. I can just say that from the Fed's perspective, it does not and should not be perceived as routinely weighing in. It just turns out that in the last 15 years, we've had two very serious disruptions: a global financial crisis and a pandemic. I gave a talk at Columbia Law School about 15 months ago on the topic of a related topic, and my point there is similar to what I just said to you, that an issue for the Fed is that once the Fed has deployed an unusual tool to support market function, then I think it certainly increases the odd that it may deploy it in the future. So, for example, in the dark days of March of 2020, when we did roll out programs to support the financial system after the pandemic and the shutdowns, it was easy for us to roll out the programs that Ben Bernanke and Bill Dudley had put together. Literally in some cases, we opened the filing cabinet and we did launch very quickly a money market and a commercial paper program. So certainly there is an institutional connectivity there. It's my hope that because of the 13.3 requirements as they've been tightened, that would limit the moral hazard expectation. But obviously, that's something that's not quantifiable right now.
Yeah, that's super interesting discussion. I think it's very important. Sam, if you want to get in.
Yeah, I think obviously the question of moral hazard is an important one. I wonder at times if we overstate it. Not that it's not important, but I'm not sure how much it can account for some of the developments in finance, because there's been plenty of failures. I'm not sure that we see time and time again people being very willing to adopt strategies that are very risky, even when this leads to so how many bank failures have we had in the US since the beginning of the 1980s? I feel so it doesn't take away the idea that there's too big to fail is an issue and that banks exploit it, but I'm not sure that moral hazard can account for as much as we tend to put on the notion. And so I feel like we need a more robust account of what is driving some of these developments, which will then have an impact on how we think about regulation. But I'll leave it at that.
Okay, Katarina. Thank you, Katarina.
Yeah, I'm just listening to the conversation. I'm wondering whether we can go back to the fundamental question of the interaction between governance, either through monetary policy or regulation, and financial innovation. Because also coming back to you, Sam, you were saying that it's not so much about just looking from the states and public perspective and then seeing how the financial sector gets around the constraints, but there's of course power games within the financial sector, and there's innovation within the financial sector that then may not have been targeted at getting around some rules and regulations, but effectively does that. But I think there's also this constant dance going on, right? So much of the innovation, sort of what you call liability management, I think is a response to tougher regulation. I think you say it yourself. And I'm just wondering how we should think about this. I mean, clearly, once you put some constraints into the system somewhere, and you can't ever catch the entire system equally, you will push a system that's very sophisticated and has many different tools to use them to get somehow around this, because they're not just they're just not passive puppets, but they are in a competitive financial system where they're trying to get an edge over everybody else. So let me just propose, I would actually argue that regulation is an incentive for financial innovation very often, but in ways that are highly unpredictable for the regulators. And that also suggests that the issue is not just moral hazard, we just play the same risk game again, but it's basically, it is the response to tighter regulation creates an innovative push that the regulators and the monetary authorities have not anticipated, which is why they become increasingly reactive. And that dynamic allows people to sort of innovate more. Just don't call it moral hazard, but say this is just like it's a natural process of innovation, trying to push the limits of the system even further. And there might be in the background something like, we can, if necessary, we just blue mail them and they will bail us out. But I think it's not from the get-go a strategy to be bailed out. At the end, people want to make money. And so this process of trying to get around legal constraints, getting ahead of competitors, using new strategies, whether this is non-bank financial intermediation, whether these are the classic shadow banking strategies, and looking at the legal structures of both, I think it's actually the same. It's just more people doing it, right? It's the same kind of intermediation processes that through long chains of intermediation outside an integrated banking structure, doing it, transnationally, etc. I think so. If we think about it in those terms, that of course any intervention in these financial markets will give rise to innovation, but we have a regulatory structure that is inapt because it is far too rigid in responding. We had that theme already last time when Charlie Calomiris was saying, the supervisors have the powers to go in and do stuff, and they don't do it. So yes, I mean, here I think right now in the conversation, it sounds a little bit more like they don't have the toolkit. They don't have the toolkit to deal with hedge funds, for example. And I think Calomiris was saying we have them mostly for banks. So for some, we don't have the toolkits. Maybe we need those toolkits, but we need flexible toolkits. Raises some issues about, regulatory constraints, but I think also goes back to Viral's point earlier. If we do sometimes, because of systemic importance, have to bail them out exposed, we have to think much more about ex-ante governance that we're currently thinking. And also that involves, of course, the monitoring of the system for innovation and the systematic exploration of what the implications of these innovations might be for the stability of financial markets in the long run.
Yeah, if I could follow up on that, I mean, I really like this dynamic model that you just outlined, which also could allow to bring history in. Like first you have the financial innovation, then the actors become more reactive, the Fed, and I think the 1966 credit liquidity crunch is also one of those moments where the Fed tries to take back control after the certificates of deposits have been invented and realizes that it can't take back control really and has to be accommodative. So there are battles that are lost, which leads to accommodation. And then to me, right now, the only reason why maybe, Richard, I would tend to disagree with your characterization. I agree there have been two crises, 2008, 2020. But when you read the financial stability reports from 2016, 17 in the US, from 17, 18, 19, 20, they're all about the growing risks of short-term funding and long-term assets in the asset management industry. Like even Mark Carney goes out there and says, this is based on a lie. I find the regulators actually pretty vocal on these risks, but at the same time, it seems that as if they don't have enough tools. And then really one has to ask, what in the world is there that could, the sophisticated investor. I mean, hedge funds are the sophisticated investor that is in that way and for that reason protected from a lot of reporting and so on, and a lot of the grip that comes with other investors is not extended to hedge funds. And I for me, the political economy resides there. Why do certain actors get or are allowed to innovate in these kind of fashions when people actually are really concerned about them? I don't know if I'm making myself clear, but we observe observers, we observe regulators, we observe financial market observers that are very worried about it, and that seem almost like as if they can't do much about it. So for me, it's not a question of not observing. For me, it's a question of not acting, and but that's the way I see it.
But should I?
Yeah, please.
I think the issue is whether it's obviously it's a political question, and so you could assume that they're not able per se, or that they don't want to, or it's difficult for them to do it for various reasons that are not simply about capacity, but they can have to do with a lot of different things. So I really like the way you put it, Katerina. I completely agree with your characterization of it. Part of what I was doing in that piece, and I'm not the first one. I was always struck by how the actual history of financial developments in the US emphasize all the time how banks are trying to get around and struggling with the constraints of regulation. But when you move to the field of political economy, what we hear is, not the literature specialized on finance, but so often the discourse is the opposite. It's all about deregulation, financiers being able to do whatever they want. And there's a real gap between those two positions that I think is quite problematic. And so in many ways, I do think the challenge for us, though, is that although we see that banks are very crafty at finding ways around regulation, And the paradox here, it's the same argument that you can make around offshore finance and all this. The more precise you are with the regulation and rigid in the same way, the easier it is to innovate, to work your way around it. And so it's not the looseness of regulation that's the problem, as it sometimes is in claim in the kind of popular discourse, but it's the opposite. Is the very precision in the regulation that creates an ability, to work around it. So this being an issue, I think that it does raise, though, two challenges for us. The first one is to understand, what does law do then if banks can simply work their way all the time around it? And I think here we need to be careful that although the law, often regulation, doesn't seem to achieve what it claims to want to achieve or what it's trying to achieve, it doesn't mean that it doesn't do anything. And that's, I think, often a problem. We underestimate the impact of governance and regulatory structures because they're just not achieving what they set out to achieve officially, but it doesn't mean that we should dismiss their impact in shaping the trajectory of finance, even if it's because of the way it incites finance to go in different direction to avoid it. But we still need to be the challenge for us is still to specify what difference does law, regulation, governance make to finance instead of simply dismissing it. And then the second challenge is, what do we do politically? And I think that's a fascinating question. This is a question that Matthias obviously is addressing well, reflecting on in terms of some of the recent developments. But I do think here, and it goes a bit, I think, in a direction you're going, Katerina, is really to think of governance in different ways. If rigidity and precision is part of the problem, how do we think of ways in which it is possible to have a regulatory action that's not as easy to play out, precisely by not laying out the cards so explicitly in terms of setting out how things are going to be done?
Yeah, I mean, for me, one question is just a question is, one could even take just a poll. How many of the people think that if there's a serious liquidity crisis, there will be no intervention by the Fed? I mean, I agree, Richard, you have laid out the legal constraints on the Fed and the fact that 13.3 has these exigent market circumstances and so on. But from what I've, for me, it's if there's one thing that I will not doubt, it's the fact that the Fed will provide liquidity in the next times of crisis. And I'm curious.
Well, and to be clear, the Fed typically would not need to invoke 13.3 to provide liquidity to the banking system. So if there's a shortage of liquidity in the system, the Fed can lend to banks against the bank's collateral, who in turn can on-lend, and that doesn't require 13.3. But where we get into issues is whether is the counterparty relationships banks have with the non-bank financial institutions are not intermediating credit. Is that a liquidity problem, or is it a solvency problem? You know, if Bank A doesn't lend to hedge fund B because hedge fund B is about to go under, that's not a liquidity problem. That's a solvency problem. And so, and of course, in real world, it's sometimes difficult in real time to finally distinguish between those two. But to be clear, the Fed, you know, when the Fed supported the repo market in September 2019, it wasn't a crisis. It didn't invoke 13.3. It's just there was a repo disruption. So I agree with you on that. It's actually channeling liquidity directly to non-banks that requires 13.3. Interestingly enough, a little footnote here. The Fed's intervention with SVB in March of this year actually did require them to invoke 13.3 because of the way they structured the program. They structured the program whereby they would lend for up to a year against the par value of securities. And because of that term, and because they were lending against par value as opposed to with a haircut, that the Fed's lawyers encouraged them to invoke 13.3, even for a program supporting the banks.
Shall we just, I think Erin had a comment in the chat. I see that we're out of time, but I just wanted to draw people's attention to it because she's basically, I think if I understand correctly, and Erin, chime in please if I'm not, saying that macroprudential regulation has failed, right? Because you're saying that that was supposed to address the issue that I raised, sort of the stance of the regulators and the innovators, and yet somehow it's not working properly. So it's a bit difficult to end on this note, but I think Matthias, unless you disagree, I think we have to, because we also promised the commentators that they can go home at some point. So I just want to say thank you for all for participating. We think of this as a continuing conversation, so we would appreciate if you came back. We have another session coming up on the 13th of November, and Viral Acharya and Charlotte Rommerskirchen are both here. Today they will be talking about the management of liquidity in the context of sovereign debt in particular, and we will invite you to all come back in a couple of weeks for another session of this political economy of liquidity here at the Center on Political Economy at Columbia University. Thank you so much. Matthias, you want to just thank our commentators and then we'll close? Yes, so you are muted right now, so let me just pick this up. So thank you, Richard, and thank you, Sam, for joining us. It was a really wonderful session. Thanks for all your efforts in putting also the readings together with us, and we hope that you can also come back to and see us in one of the next sessions. But thank you so much. It was great to have you. Bye.
Thanks.
Thank you very much. Bye-bye.